Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our February 2026 Review and Outlook presentation. That's right, we're now Shelton Capital Management. The team from Stringer, the entire team, has moved over under the Shelton umbrella. The core of our team has been together for more than 20 years, managing these strategies and similar strategies. So the team's been together for a long time. We're just now under a broader umbrella. An organization like Shelton brings more support resources to us, so we can actually have more time to spend on these strategies, working to support financial advisors, financial planners, and their clientele. Now, regardless if you're watching the video or listening to the audio podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlook. For more details, please contact your financial advisor. And thank you again for joining us. So our theme for February 2026 is rotation, not recession. A broadening market emerges. What we've seen is a rotation in the equity market participation. We've seen a lot of volatility recently, but it's mostly concentrated in software businesses. So even when we think about the broader information technology sector, the software businesses within that sector are really the areas that have been struggling. Other areas within the information technology sector, like hardware and semiconductors, have actually held up much better. But what we're seeing is a rotation across sectors. So we're seeing broader participation in the equity market than we've seen in recent years, and we welcome that. We're seeing economic resilience, especially in the United States, where we're ending 2025, the second half of the year, we're averaging 4% annualized growth, and the economy remains strong. A lot of momentum coming into the new year, and this is growth that's supported by Federal Reserve interest rate cuts, which is very much unlike what we saw in the 2000s tech bubble, where we saw actually the Federal Reserve raising interest rates in that period of time, which just created a more precarious position. That's unlike what we see today. What we see today is very different. What we're seeing today is a lot of private sector strength in households and in private businesses. The core of the economy is the private sector, and it remains strong. We're seeing steady growth and improvement there, excluding sort of volatile trade data. But the core of the U.S. economic engine remains very healthy. And reflecting that and building on that, we're seeing capital investment, capital expenditure growth. So rising corporate investment in property, plant, and equipment points to sustained productivity growth and industrial gains in the coming years. So it takes a long time for these new factories, new facilities to come online, but when they do, they pay dividends for years to come. And we're seeing more stability in the labor market. We saw a lot of volatility in the jobs market last year, probably bottoming at the end of in October. We're seeing more resilience and stabilization there, and we expect to see around 100,000 jobs per month on average, new gains in the coming year, which pretty much we think matches the labor force growth rate. So what we're looking at here on this graphic we want to walk through is GDP versus final sales percent growth. And especially in recent years where trade figures, net trade, the amount of imports and exports has been quite volatile in recent years. Think of when we came out of the pandemic and you had a sharp drop in GDP growth because you had an influx of imports as supply chain disruptions were resolved. And we actually see that in this chart that we're looking at here, the gold line. For those of you who can't see, if you're on the audio podcast, the gold line going negative, that's GDP growth going negative early in 2022 as a result of those supply chain issues getting resolved. That wasn't bad news. That was actually good news. And so we're seeing that play out with volatility on GDP numbers more recently in last few quarters as we've had these trade issues going on. We actually prefer to look also at real final sales to private domestic purchasers, which is to say it strips out all the vagaries and noise from these trade issues and just focuses on what's going on with the core of the U.S. economy, what's going on with the private sector, with households and businesses. And we can see that line is much more steady and persistently showing growth. That's a very healthy signal that the private sector continues to grow at a consistent pace. In fact, we can see this expressed with business confidence in property, plant, and equipment investments. This next graphic that we're looking at is from 2019 onwards, where we're seeing the investments in property, plant, and equipment growing and actually accelerating. And here we're comparing it to the previous business cycle average. This actually we saw this uptick begin in 2015 to 2017 as onshoring picked up, and global businesses were bringing more and more factories back to the U.S., and it's only accelerated in recent years. And so while it takes some time for these new plant and equipment to come online, the efficiencies, the productivity gains will pay off for years to come. We're very optimistic about that. Monthly jobs gains has been quite volatile, and with the reductions that we've seen with respect to the revisions in the jobs data, can be quite unsettling. There's a few reasons that's why we actually look at other things, not just the monthly jobs reports, because the monthly jobs reports is just a survey, and the responses to the survey aren't as solid as they used to be, meaning they're not getting the same percentage responses as they used to. So the data isn't quite as clean. And this is one of the reasons why you get these large revisions from time to time, when they get to compare the survey responses to actual tax data and census data, for example. The hard numbers can be quite different. But we like to look at things a couple of different ways, including using a moving average. So here we're looking at the 6-month moving average, kind of smooths out the volatility in the month-to-month gains. And we also look at things like layoffs, because layoffs, the unemployment claim data that we use as a proxy for layoffs, it's not a survey. It's actually how many people signed up for unemployment insurance. And what we're seeing is that being range bound in kind of a healthy range. And here we're seeing a bottoming in the monthly numbers of jobs creation back in October, because with those federal government jobs reductions, a lot of furloughs and early retirements, a lot of those people were technically on the federal government payroll until the September-October timeframe. And then you see that dip and a bottom, and we're kind of creeping back up as the private sector jobs growth takes hold. Since the bulk of the federal government jobs reductions are behind us, we think we're going to start seeing a more steady rate of net jobs gains in around 100,000 per month, which basically matches what we estimate the growth rate of the labor force to be. So that's 100,000 new entrants, new jobs, over 1 million new jobs per year, which is actually quite healthy when it comes to economic growth. So investment implications. We welcome the recent broadening of the equity market participation with additional countries, not just the U.S., and also within the U.S., additional companies and stocks, not just the Magnificent Seven. And while we think that these companies will remain very important with respect to stock market gains going forward and the economy more broadly, other sectors such as industrials and healthcare are now participating in a more meaningful way. We continue to overweight equities versus fixed income, and the U.S. versus foreign countries in these previously mentioned sectors, as well as financials and small caps. Regarding fixed income, we continue to see opportunities in the belly of the yield curve, sort of that middle part of the yield curve, where we've really tightened up our interest rate risk, and overweight asset-backed securities for both their quality and their attractive yields. Now, this is something that is much more efficient to do in the types of investments we're using, such as exchange-traded funds. It's very difficult to do that on an individual bond basis. Our alternative investments continue to focus on options overlay strategies, equity options overlay strategies that enhance yield, as well as we've added a real return multi-asset strategy that's a lower correlation to traditional stock and bond markets. So here we're looking at the favorite choices on the table here: healthcare, industrials. We still like technology, but as I mentioned, we tend to do it actually in a more diversified way, where we're using an ETF that's more equally weighted. So it's not just the major names. There's also a lot of secondary names that get to participate here. And financials is one of our tactical overweights as well. The cash indicator. The cash indicator has been relatively stable, even as we've seen some equity market volatility. Really, confidence in the bond market has been an important stabilizer for the cash indicator. And overall, we see the current cash indicator level reflecting a healthy amount of skepticism, investor skepticism in the equity market. If everyone's euphoric and things are looking great, everybody's optimistic, and the market is easily surprised, or more easily surprised anyway. If you have some skepticism, that creates some redundancy, some more robustness in the market. And so we think it's a pretty healthy situation. And with that, I will close by again thanking you for your time. If you have any further questions or would like some more information, please contact your financial advisor. They'll be happy to help.